Much. Hopefully everybody is hearing me and seeing what they're supposed to be seeing. I thank you all for taking the time to join us today. If it's not a busy time yet, I know it will be very busy for you here shortly. So certainly appreciate you joining us. Also, hope you all have a nice cup of strong coffee in your hand, because I am going to throw a chart or two at you, and hope you guys are on your toes. But I think, you take a look at the market situation right now. There are a lot of things that we can feel pretty good about. So probably you won't need anything stronger to drink later this morning after this talk. So with that, we can go ahead and get started. And of course, what is central to this discussion is what's going on with cotton prices. Of course, yesterday we did have a relatively significant correction in the market, and we lost 2-3 cents per pound. But the good news is, that the trend that's been in place since April of 2020 is still there. So prices have generally been increasing for the past year and a half. We define an uptrend by a series of higher lows. And if you take a look at, even with what happened yesterday, we are still on pace to maintain that upward trend. So the trend is our friend. As long as we can keep north of that trend line, we could potentially expect further gains in the cotton market. Of course, given the fact that we are on that line right now, it's something we need to watch. If we do break below it, it could set up a new trading pattern for prices. But certainly a lot of gains have been marked since the post-COVID low of April 2020. And the gains that we've had in the cotton market are pretty extraordinary, particularly when you consider not only is COVID still very much out there in the world, but also that the world is sitting on a lot of cotton. Here we're going to take a brief stroll through some of the recent history just to make sure everybody's on the same page before we start getting more into our outlook part of the discussion. And of course, what's very important was the effects of COVID and what it meant to global supply demand situation. If you go back to the 2019-2020 crop year, when COVID really hit the market full bore, of course, we had a collapse in global mill use. That opened up a production surplus of 20 million bales. This is the second largest addition that we've made to global ending stocks on record. It's second only to what happened in the aftermath of the price spike. So a huge addition to global warehouse supplies, roughly equal to the size of an entire U.S. cotton harvest. Since then, we have taken some withdrawals from our cotton stocks. Last crop year, we grew a little bit less than we consumed, with the difference being about 7 million bales. In the upcoming or current crop year, we're expected to take another withdrawal of about 5 million bales. Once again, hoping you guys have that cup of coffee on hand. If I can ask you to do some quick mental math, if you add 7 plus 5, you get 12. 12, of course, is less than 20. So if you net everything out, we're still up about 8 million bales relative to where we were back in 2019, 2020. 8 million bales is pretty significant when you take a look at the volumes for global cotton stocks. It's somewhere around 10% of the total. So we're up 10% relative to we were in 1920. And then in 1920, we weren't even in a deficit situation. So we do have a decent amount of global cotton supply available to the market, which makes the gains in prices all the more noteworthy. Here we can take a direct look at global cotton stocks. Once again, expected to make another withdrawal in the current crop year. But even with the withdrawal they're expected to take this season, the forecast is that global ending stocks will still rank in the top 7. Doesn't sound potentially too extraordinary, but it's still a healthy volume of stocks. Something else I'd like to highlight too here is that how we have made a stair step higher in terms of global cotton supply. So there has been a transition in the market since the cotton price spike. The cotton market seems to want more cotton stocks, and it's been commanding that through higher prices. And I think we're seeing that play out in the current season as well, when we do have a decent amount of cotton supply out there and also have some pretty solid cotton prices. So for those of you who took your ag econ class, you can remember back to our stocks to use ratio. It's another way we can relate supply and demand situation back to prices. Simply the ratio of ending stocks over cotton demand. And if we take a look at those numbers, we also see figures popping up in the top 7 for the current crop year. So it doesn't stand out as being potentially extremely high, but still pretty high relative to where we've been historically. Something else I want to highlight here is that this other hump that we had just about 10 years ago was associated with the buildup in Chinese reserves that occurred after the price spike. So after the price spike, the Chinese government, in an effort to maintain domestic cotton acreage and also potentially to hold off price volatility such as we experienced during the price spike, they built up a massive volume of government supply. That government supply system operates somewhat like our strategic oil reserves, and that when prices get high, they'll make releases, and then when prices are low, they can support the market and make some purchases. But during this time period, those reserves climbed to unprecedented levels. And a key feature of the Chinese reserves during this time period is that they weren't being released into the market. So even though those supplies physically existed, they weren't there to weigh on prices. And as a result, in the analyst world, we've gone to a different or alternate set of stocks-to-use ratios to back into prices. And not too complicated, what we do is just simply subtract China from the rest of the world to come up with this alternate specification. When we do that, you can see that hump that occurred after the price spike disappears, and that makes the current numbers stand out a lot more than they do otherwise when China is included in the scenario. So when we take China out of the situation, we have global stocks ranking in the top 3, which once again underlines the point that the world does have a lot of cotton supply out there right now, making these price increases that we've had over the past year and a half something special. We've taken a look at a lot of other specifications for stocks-to-use ratios. We've taken India out of the equation. We've taken Brazil out of the equation. But if you want to find a situation that is showing tightness, really the only one that really stands out is that's not too far from home, and that's here in the U.S. So last crop year, we saw our stocks-to-use ratio drop to the lowest levels that we've seen essentially in the modern era. And when we take a look at sources, potentially contributing to the price increases, the U.S. cotton situation is one of those. In the current crop year, we are expected to see stocks increase a little bit. There's a lot of room for that number to change. We are very early into the season, and we'll talk about some of the factors that we can expect potentially to change down the road and help shape the price outlook for the current crop year in these later slides. But first, I want to retread a little bit more history and just take a look at some of the changes that led to the tightening in the U.S. cotton situation last crop year. So here on the left, I'm showing you USDA production forecasts made at different periods in time, running from August through their final number that comes out in May. During that window of just those few months, we saw the USDA drop their production forecast by 3.5 million bales. Usually changes of that magnitude do not happen. So some volatility in our production estimates potentially contributing to some of the volatility we saw in price movement over the past year. Something else that's notable is when these changes occur, they occurred pretty late in the season. So in December and January is when we saw the biggest downward reductions to the USDA production numbers last year. So information hitting the market later causing them to drop their figures. Of course, the driver of those reductions was the dry conditions out in West Texas, and also the series of hurricanes that made their way through last fall. There was an evolution in the production outlook for the U.S. last year. And then on top of that, we had demand be a little bit stronger than probably could have been expected earlier on. So last crop year, we just had this data come in last month. We ended up with exports that were 7% higher than they were the year before. Once again, this is pretty great given the fact that last crop year was completely coincident with still some pretty heavy COVID situation. You take a look at what was driving that increase. A lot of it had to do with China. Our exports to China doubled last year. In the first half of the season, we were shipping a record amount of cotton to China, which once again is very significant because there were some pretty bad months there early in the crop year for COVID. And that strength for China compensated for some losses we had in other markets. So you may be familiar with the fact that our shipments to China had been depressed prior to last year. In the 5 previous crop years, Vietnam had been the top destination for exports. Last crop year, our shipments to Vietnam were down about 16%. So that's down 1 in 6 bales. So a meaningful decrease there. And if we take a look at our other top 10 destinations, we also saw some pretty sizable declines. Pakistan, which had what has been called widely as a crop failure last year, still took a little bit less cotton from us than they did previous seasons. Turkey took 1 in 5 fewer bales from us last year than they did the year before, and similar declines from both Bangladesh and Indonesia. If we go through the rest of our top 10 export destinations, the only other country that took more cotton from us last year besides China was Mexico. We did have a healthy increase there in percentage terms. A lot of that has to do with timing of COVID. Mexico decreased its imports from us pretty sharply in the 1920 crop year. So that set them up for a recovery in the 2021 crop year. Balancing everything out, you can see how COVID once again was a pretty heavy factor last year. China fortunately able to counterbalance that for us, leading us to have an increase in exports last season despite COVID. Last year, we actually exported the second highest volume on record, around 16.5 million bales. Here's take a little bit closer look at the Chinese data, since this was such an important factor last year. Over the previous 5 years, for some reasons that we will talk about in a little bit later, our exports to China had been depressed. Last crop year, we shipped over 5 million bales to China. So once again, more than double what we've been shipping previously. But really, this is just a return to levels that we have been shipping to China in the not so distant past. So if we go back to mid 2010s and throughout much of the 2000s, we were routinely shipping 4 to 5 million bales to China. We have shipped as much as about 9 million bales to China. So what we are doing is we're transitioning from a period of depressed exports to China to a period of more normal trade. And of course, that has been healthy for our overall export demand. We put those together, the strength of our exports along with smaller crops set us up for a tightening. Another component that contributed to that strength in our exports to China was probably the phase 1 deal. Here's just some of the details associated with phase 1. Phase 1 is all cast relative to a baseline. That baseline is 2017, which is prior to any tariffs. In the 2020 calendar year, we were supposed to export 12.5 billion beyond that baseline level. We didn't quite get there in dollar terms, but there was a lot of increases in volumes, not only for cotton, but also for a lot of other agricultural commodities as well. In the 2021 calendar year, we're supposed to go another $7 billion beyond where we were in 2020. So still looking at some support from China, stemming from phase 1 through the remainder of the calendar year. Of course, when you take a look at the 21-22 crop year, that's more than half of it's going to occur in the 2022 calendar year, and it is unknown what is going to follow the phase 1 deal. So there is some uncertainty out there, but I think most expectations are that trade with China probably will continue somewhere near the volume that it was in the previous crop year and calendar year. As we look ahead, the uncertainty associated with what might follow the phase 1 deal is going to be very important, particularly given the fact that the crop looks to be a good bit bigger this year. If you track the crop condition ratings, we've had about consistently 60 to 70% of this year's crop rated good or excellent. These crop condition ratings are the best that we've had going all the way back to 2004 and 2005. What that means is this should be a year of low abandonment out there in West Texas, given the moisture that they've had, and also should be a year with decent yields in most areas as well. So we're going to have more cotton to sell, and of course the pressure remains on exports if we don't want to have that build up in terms of cotton inventory here in the U.S. We've already seen that show up in terms of USDA figures. We did see some significant revisions this month. USDA increased their forecast in September by 1.2 million bales versus August. So pretty significant monthly change there. You want to compare where the current projection is relative to last year. USDA is predicting a harvest that's about 25% bigger, or about 4 million bales larger than it was last season. So if you want to back this in against exports, we increased our exports to China by about 2 million bales. And you can see the increase in our crop is about double that number. So once again, if we don't want to have a buildup in stocks, the heat is on exports to keep that cotton moving. Here we just get a better view for that. So we've got our production numbers stacked up against our demand. And you can see, clearly the vast majority of our demand now coming from exports. In terms of domestic consumption, we are expected to see U.S. mill use recover about 100,000 bales in the current crop year. But our domestic consumption has been suffering over the past several years. It's challenging to get consumption numbers with a lot of history. But at least as far as I've been able to dig back, we're taking a look at the weakest U.S. mill use that we've had, probably dating back to pre-World War I. So talking about the weakest mill use we've had in about 100 years. So once again, if we want to move that cotton, a lot of it's going to have to be through exports. And there's some good news out there. So we talked about, the phase one deal. There's some questions about what's going to happen in terms of what succeeds it. But there's also some other dynamics that are at play in China that also can be helpful. One sort of background set of statistics associated with that is the fact that China consistently consumes more cotton than it grows. China is the world's largest cotton spinner, consuming about a third of all the cotton that's consumed every single year. China is the world's second largest cotton producer, but once again, a significant gap there. The gap in recent years has been over 10 million bales, and that is not uncommon for China in the modern era. Traditionally, that gap is filled by imports, but things have been a little bit funny here in recent years. We already touched on Chinese reserve policies and the reserve system. Given the fact that they accumulated so much cotton after the price spike, there has been a period where the Chinese government has been focused on drawing down their reserves. But the good news is that drawdown has come to an end. So we did see Chinese reserves at a level equal to about 2 years of mill use. Current estimates are indicating that Chinese reserves are down to about 3 months of mill use. And the Chinese government has told us that a goal of their reserves is to stabilize reserve levels. So what that means is that if they're stabilizing the amount they're holding in reserves, they need to be bringing in imports to completely make up for their production deficit. So that is something that can support Chinese import demand. And that's something that can be expected to support Chinese imports of U.S. cotton, even with some questions about the phase one successor. There's also issues of rotation there. The Chinese government is focused on quality. They want to rotate out their old stocks and bring in new stocks. Bringing in imported cotton is considered a way for them to do so. So whatever they're selling needs to be replenished. Chinese government has been selling cotton. They've been selling cotton out of their reserves since July. This current round of sales is expected to extend through the end of September. And during this time period, they're expected to sell 2.5 million bales. So that means 2.5 million bales needs to go back into a Chinese reserve system. And that, of course, can support Chinese import demand and can help absorb some of this extra cotton that we're growing this year. And then, of course, the world is greater than just China as well, too. And if you want to take a look at some good news beyond China, the good news is that the world is expected to experience some pretty strong rates of global GDP growth. Of course, we did have a significant contraction in 2020, but in 2021, we're expected to grow at twice the rate that we had in 2019. There are some estimates that the world has already progressed to a level of economic activity greater than it was prior to COVID. So any growth that we get beyond there is outright, and then we are expected to have a very strong rate of growth in the 2022 calendar year. So that's going to support consumer demand and should support mill demand. And that's true not just for China, but also for a lot of the other markets that we export to. When we take a look at factors that are correlated with changes in global mill use, global GDP is one of the strongest one of those. We saw a significant recovery last year. So what I'm showing you here is year-over-year change in mill use. And you can see very strong rates of growth across the board. These are the world's top 7 spinning countries. Every single one of those countries enjoying pretty significant growth last crop year. Every single one of those countries is expected to continue to enjoy some growth in the current crop year as well. The rates of growth are expected to slow, but they're building, they're compounding. So the growth in the current crop year is building on growth we had last year. That growth in GDP expected to continue to support cotton demand across the board. We can take a look at expectations around the world in terms of production. When we take a look at these numbers, they're a little bit more mixed. Generally, that's because if a country has either good or bad growing conditions in a given year, they'll tend to have a return to the mean in the upcoming year, or at least the USDA will factor in a return to the mean in terms of weather conditions in the new crop year, and that will result in a counterbalancing change in production. So take a look at Indian cotton situation, not much change either last year or this year. In China, they had pretty good weather last year. A return to mean growth and yield is expected to result in them having a little bit of a smaller crop this year. See some big swings in the US numbers. Once again, that weather in West Texas is a big factor, but I think it is interesting to take a look at the volatility of US production compared to some of the changes we see in other growing areas around the world. Brazil has had some weather issues this year with some drought, return to average weather conditions in the current season, expected to bring a few more bales out of their crop in the current crop year. Pakistan has had a series of issues with their production. As I already mentioned, they had what's been calling a crop failure last year. They're having issues with pests already this year. I think we'll see that their crop number come down as time goes on. That does have some relevance for us. Pakistan was our third largest export market last year. Pakistan is growing about half the amount of cotton they were growing 5 years ago. The challenges they're having with their domestic crop probably will be a signal that we'll continue to send them a lot of cotton into the future. Australia has had severe droughts. Of course, the wildfires there got a lot of attention in recent years. Really one of the few countries that's had back-to-back growth, and that's due to the fact that they are getting more rainfall. Their reservoirs are getting filled, and that's allowing them to plant more cotton. And then Turkey, another export customer, a little bit back and forth in terms of their production, but also important to highlight that they do grow a decent amount of cotton there as well. It's a little bit of back and forth, but just want to highlight some of our customers, particularly Pakistan, can be expected to be buying cotton from us this year, given the fact that they are growing so much less cotton than they have in recent history. Something else that's encouraging on the demand front is just the growth that we're seeing on a consumer from consumers. Here's the year-over-year change in U.S. apparel spending. A couple of things really stand out. Of course, the losses that we had with COVID. We had record year-over-year rates of decline between March and May of 2020. Given the fact that things were so bad then, we've had some very strong rebounds in the spring and summer of this year. If you think about changes, percentage change, and how the math works there, if you do have a 50% decline, you need a 100% increase just to get back from where you started from. Take a look at these numbers. We were down 40% and we've had growth over 100%. So the bottom line is that we're in a much better place than we were even prior to COVID. There's some distortion in these figures because, once again, year-over-year comparisons are a little bit funny. But if you make comparisons back to 2019, which is prior to COVID, consumer spending is up about 25%. Normal rates of annual growth in consumer spending on apparel are about 3%. So we're doing leaps and bounds beyond what could have been expected in normal time periods. So consumer demand is doing very well. Of course, online spending has been a big component of that, but brick and mortar sales are also doing better. So you take a look at some of our traditional retailers or traditional importers of apparel, they've also been doing okay. In recent months, their sales have been up 15% versus 2019 levels. So very strong growth there as well. So not only are we back to where we hope we would have been pre-COVID, but we're doing better than probably we could have even imagined without COVID. And that's starting to show up in our imports too. So here we're working our way upstream, getting back a little bit closer to fiber demand and what consumer demand relates back in terms of bale volumes. This is the raw fiber equivalents of U.S. imports. If you take a look at apparel volumes, we're expected to, at least in terms of our rate so far this year, had the strongest imports we've had since the price spike. And we're expected to be up about 1.5 million bales relative to where we were pre-COVID. Then if you take a look at the home market, we've seen even stronger growth. We're setting records in terms of the amount of cotton we're importing in terms of home furnishings. It's a smaller market, but still up about 500,000 bales. We add those two together, we've got an increase in demand for fiber of 2 million bales just here in the US. Of course, the world is bigger than the US. Similar situations can be expected in other markets, particularly as they get further down the road to recovery post-COVID. And all this indicating that demand for cotton fiber can be expected to be healthy into the future. One reason why we can say that, at least in the US, is by taking a look at inventory sales data. So this is the ratio, the value of inventory held by clothing stores relative to their sales. You can see how things jumped off the chart with COVID. It reached levels 7 or 8 times the historical average. But even with that distortion on the chart, you can see that inventories are very low. The fact that inventories are low will be something that will continue to support import demand here in the US. So we've already had imports being strong, already pulling more fiber through the supply chain. That can be expected to continue because retailers don't have a lot sitting in storage right now. And of course, there's the issue of prices as well. So is our prices going to choke off demand? We can get a better flavor for that by taking a look at changes in prices. What I'm showing you here are indexed values. So we're showing changes relative to January of 2020. So changes relative to where you were pre-COVID. Take a look at cotton fiber prices. They bottomed out at a level about 25% lower than when they were in January of 2020. The current level, they're up about a third relative to where they were in January of 2020. We can add other elements of the supply chain. So here we take a look at yarn prices. Of course, they follow cotton prices pretty closely. But when you think about yarn and how yarn costs change relative to fiber costs, we need to remember that yarn includes other things besides fiber. It includes electricity, it includes capital costs, it includes financing. For those reasons, we should expect changes in yarn prices to be smaller than the changes that we see in cotton prices. That was the case on the downswing when you saw yarn prices drop 10 percentage points less than what we saw in terms of the drop of fiber prices. But in terms of the recovery, we saw yarn prices actually increase at a faster rate than fiber prices. When you think about the supply chain, you think about mills, what that probably is an indication of is that their margins were able to increase. There's a scramble to secure yarn. And in that scramble, our spinners had some pricing power and they're probably able to improve their financial position. So we see, demand being strong throughout the supply chain. We're also seeing spinners sitting on decent margins, which should mean, once again, there is some legs to this recovery. We do see the buyers of fiber in a decent financial position. We do see a little bit more of a challenging situation when we take another step downstream. Here we're taking a look at the average cost of goods coming into the US. If you take a look at the average price per square meter equivalent of cotton dominant apparel coming into the US, it's actually down relative to where it was in January of 2020 or pre-COVID. There has been some gentle upward movement in these prices over time. But you take a look at these retailer sourcing costs, they're not facing too much pressure on prices yet. And actually, if you take a look at this data point here back in March of this year, that was a record low for cotton dominant apparel import prices. So there also is potentially some room for some margin protection among our retailers. Of course, retail apparel costs have been increasing. A lot of concerns about consumer inflation here in the US. The year-over-year rates of increase in terms of consumer prices have been pretty strong, around 4 or 5%, which is much higher than rates that are typically somewhere near zero. But if you compare to where we were pre-COVID, we're still down. So we had some very steep declines with the onset of COVID. And even though apparel prices at retail have been increasing, they're still below where they were back in January of 2020. There's still some separation between sourcing costs and retail prices as well. So retailers also, in terms of margins, may be doing okay. Although there's some other factors like shipping costs that, of course, are causing them some headaches beyond just changes in cost of goods. So by this point, I think you guys have seen a lot of charts. I'm going to start to wind things down a little bit, starting to bring some of the pieces together. But something I've just been trying to highlight is there's a lot of positives from the demand side. We're already looking better than we were before COVID on multiple fronts. Consumer demand is very strong. The consumer growth we're seeing in terms of spending is at very, very strong levels compared to where we were before COVID. Inventories are low. The refilling of the pipeline, particularly with some of the margins that are in place throughout manufacturers or retailers, should be something that could continue to support order placement. There are questions about phase one, but growth in those other markets, so those negative 15 to 20% values we saw for countries outside of China, I think we could expect those countries to start to return to levels where they were prior to COVID. And if we have growth there paired with sustained growth from China, I think we could be expected to have very strong exports in the current season. Depending, of course, how COVID and some other factors may play out. So something that could be supportive of prices is strong exports from the U.S. if it's maintained in the current crop year. That's going to have to be balanced against the fact that we still do have ample global supply. We're still sitting on more cotton than we were in global warehouses than we were before COVID. And you take a look at our global stocks-to-use ratios, particularly when we subtract China out of the equation, we're still sitting on top three in terms of supply relative to demand. So some mixed signals out there in terms of price outlook. Global supply is ample. U.S. supply can be expected to remain somewhat tight. Of course, a couple of factors to watch there. They say big crops get bigger. I think we will see the U.S. crop number grow over time, but we'll probably see U.S. export number grow over time as well. Demand for exports and then also demand for cotton at large has been supported on multiple fronts. We need to keep an eye on COVID and how it plays out with vaccines versus variants. And then finally, trade policies, the ongoing tensions with China are something to watch. We have seen prices react to that over the past couple of years. We've also seen prices react to macroeconomic influences. I think that was the case yesterday. If you take a look at, the analysts, they're focused on the stock market. There's an increasing number of them. They're expecting some kind of correction in the stock market this fall with a 10, 20% reduction and maybe some of our stock indexes. If that does occur, I think we maybe could expect some pullback in cotton as well, given the fact that correlations have been pretty strong since COVID. And then finally, Federal Reserve policies, how that affects not only the dollar, but also the stimulus it provides for the U.S. economy and global economies. As that gets pulled back, that may create some headwinds for cotton, further gains in cotton prices. So with that, I hope I was able to keep you guys awake despite all the charts. Certainly welcome any comments or questions that you might have.